All right, great. We're live. We're live with the Mortgage Podcast, started by really the brainchild behind this was Bob Niemi, and extraordinaire CMB and one of the leaders over at Wiener Brodsky in Kiter. And
Kiter.
What's that?
I just said Kiter. Don't forget Mitch.
No, I didn't. I never. How could you possibly forget Mitch? I wasn't sure if you were correcting me. It should be Kiter, Brodsky, and Wiener or something like that. But Wiener, Brodsky, and Kiter, and myself, Rick Roque. I'm a retail mortgage banking expert on the origination side, and we have Nolan Turner, both a friend and a gosh. There's so much you could say about your career, Nolan. Servicing expert, data analytics researcher, origination expert, and kind of I always consider you kind of an institutional guy. There's a lot of leaders that kind of sit on the sidelines and they kind of will criticize the MBA or they'll criticize like what's happening around them. And there's people like you, and I would consider Bob very similarly, where you have gotten very much involved into helping just provide whatever in this moment in time that we have in the industry that where we participate. You've decided to be a much more active voice in how policy gets made and in the priorities of the industry. So I love it, man. I love your involvement. So I'm been super excited to have you on the Mortgage Podcast.
Thank you.
So this is not a deposition. Okay.
You only answer the questions you're asked.
Yeah, exactly. So why don't we start with you, Bob? I know you had some questions around Nolan and his experience in this CMB journey. I would love to sort of dive right into there and just to get Nolan talking here.
So where do you want me to
first
start?
Off,
go ahead.
I got a question for you. So first off, Nolan, also a great CMB, great leader within our society. So appreciate that. And I know you're also stepping up to leadership for Texas Mortgage Bankers Association. Saw you last. You're going to be you're the vice president now?
Vice president this year, will be president in April of 27.
That's great.
So following Aaron D, who just rolled off, and now Pam Jenkins is our president, and both incredible ladies. I'm blessed to serve alongside them, and obviously really excited for what Pam had this year, and even more excited for what I'll be able to do in 27.
Awesome. Yeah, I was happy to be at the Texas Mortgage Bankers Conference this week. Saw that. Great. I think Aaron certainly had a great year of leadership, and excited to see what you have, as well as what Pam has for us for this year as well. Now, I have a fun question for you. I've stalked you a little bit, just looking at your background, just to give you some questions. So your LinkedIn profile pic, is that a real Nolan pic, or is that AI assisted?
It is a good pick.
It's me. It's me for sure. Doesn't look like me. Now the AI thing,
If you haven't seen it, you got to visit Nolan Turner's LinkedIn page. Ask him to connect with you if you're not connected. But he's got one of the happiest, best picks. I'll tell you, I've seen many people.
It is a good looking pick.
So a work question, and just thinking back, market disruptions, regulatory pendulums, business cycles. You've been at it. You've lived through it all. Leadership wise, what's one thing that you would say that was most impactful or most challenging to your leadership?
That's most impactful or most challenging to our leadership. Honestly, I started my career a long time ago at a company called World Savings, and then I worked in the investment bank for Wachovia, and then at Carrington. And the thing that I love about Carrington is how agile we are. We take these challenges head on when they come. And in the mortgage industry, it's never short on challenges or interesting things you have to, really think through and figure out. I don't know if there's been something that's been like really crazy challenging. I think interest rate environments, the volatility is always challenging, right? Especially when you're passionate about helping people in affordability. I think it's innovation, I guess. It's coming through those challenges and finding a way out the other side and being agile enough and being willing to say, well, this is how we've always done it. We're not going to do it that way anymore. Being able to respond and being able to do so in a short time frame. Like COVID, for example, like we moved the office from 100% in the office to 100% remote. It was like 3 to 5 days. I mean, like the team being able to adjust to that. If you look at things like policy that comes out, I think it's helpful from where I sit on the loan administration committee with the MBA and the Texas MBA and all the work I do in DC. A lot of this policy stuff, a few months, to maybe a quarter or two before it's really going to drop. So being able to get ready, being agile, being proactive versus reactive. I think we've done a really good job with that stuff at Carrington.
I was going to say, being such a large government servicer, how do you think that, there must have been obviously a concern, right? As we roll into COVID in February, March, April, May, and there's like no end in sight, and California is basically saying, you don't have to pay your mortgage. It's going to be fine. The servicers will figure it out. There must have been a scramble for dominantly government servicers in that period. It kind of worked itself out pretty quickly to be, but the future of what 2020 wasn't really quite understood until probably third quarter to be as strong as it of the back tail margin wise of the industry. But that end of first quarter, second quarter must have been incredibly challenging for all. It doesn't even have to talk about Carrington, but just for all government servicers,
Yeah, I think that the hard part when you go through any kind of crisis is it's the uncertainty, right? You can not really only trade on the data that you know. So it's really important to really understand what you have, first of all. What I would say, though, is like Carrington's a little bit different because we're a high-touch specialty servicer. So if you think about what would happen during a period of high delinquency or high stress, the borrowers probably call their servicer and say, what do I do, right? And for us, thankfully, we have a very low loan count per employee. So, for example, some servicers might have 2,000, or they're trying to even get to 3,000 loans for one FTE. At Carrington, that number is, 500, 600. It's low. It's very low.
Oh, wow.
We just put a huge focus on the borrower. Like, we literally believe you have one chance to talk to a borrower. Like, you can't miss that call. When they call, you have to answer the phone. Our speed to answer has been really incredible. I think it's less than a minute almost always. It's 20 and 30 seconds sometimes, which is phenomenal. The call abandonment rates are sub 1%. That's low. So it's really just putting that focus on the borrower. Like, that's what it really has to be if you want to be a good servicer and you want to really address any crisis. It's attention to detail. It's communication.
Do you think AI is really driving, is going to completely transform servicers across the country as far as being an asset to that borrower connection, where it's just constant, repeated, helpful, educational, and sort of autonomous? Or do you look at that as something that should never really replace, like the human that's reaching out to that consumer?
I think it depends. Look, over what time period? Like, is AI probably going to be transformational and revolutionary in our society? I think so. Will that touch servicing? Absolutely. Will it touch lending and the entire mortgage loan life cycle and other things like legal and financial and analytics? Yeah, I think it touches all of that. To what point? I think it depends. Bob and I've had some very spirited debates on this about the regulatory side of AI, and I think there's still a little bit more that needs to be worked out there. I'm not sure if I want to be the first person through the door and meet the buzzsaw, given regulatory stuff could come. So it's important to really, I think, be thoughtful about how you want to use AI.
Yeah. Mm-hmm. And because I can imagine you guys are pretty heavily invested in at least the AI, the research side of it, just to determine like process, content, delivery, frequency, touch points, like and are you building it natively in-house, or are you going to partner with different companies on the outside?
I think a little bit of both. Carrington has an incredible tech team, and we're very, very focused on the borrower journey. Right? We definitely want to be tech forward, but we also want to be very thoughtful about how that impacts headline reputational compliance and regulatory risk. Right? So we're moving very cautiously into this in a way that I think you want to be safe and really, really thoughtful about how you do it.
Yeah, no, of course.
Great insights.
Yeah, go ahead, Bob. Sorry, I don't mean to keep jumping in.
No, I just said I just had great insights. I think other people could learn from that. It's not always you want to jump and be first, be on the bleeding edge of something, and you need to make sure, as he knows, the rules don't change just because you have a new tool to use.
Yeah. What did you have another question, Bob? I don't want to jump in because I was.
I
gonna
have
ask
more,
a,
but let's
go ahead.
continue on the because I have some fun ones as well. Well, and this is a good one. And I've had this conversation with Nolan. I went to the Hurt No More parties 3, 4, 5 times. I think the first time was Chicago MBA when I was still with Ohio Mortgage Bankers. So that was a long time ago. And just recently at one point I get an email from Nolan about, I should go. And that's the point where I realized he's the no in Hurt No More. I mean, how long has that been going on? Melissa and I want to make one of those ski events.
40th year this year.
Really?
We had about 112,
Wow.
115 people in Park City, and it's been great. It's a lot of key relationships I've picked over the years have probably started there. It's one thing to meet someone at a conference and people are a little more buttoned up. It's another to go, ski with some people for a couple of days, have a couple drinks, have dinner, and you kind of get away from that conference atmosphere. So it's a lot more like friendship stuff, like Mike Dubek, the CEO of Planet, has turned into one of my best friends, incredible leader. Jason Williams at Credigy. There's been just so many people I've taken away from great relationships on that trip and amazing connections that stand the test of time in a way that some other things don't, right? People move away, but somehow people always find a reason or find a way to get to that reunion party at MBA secondary or MBA annual, and they usually find a way to get to Park City if the snow's any good.
No, you're going to be at secondary here in a couple of weeks, right?
Yep, I will.
Yeah, good.
Yep.
The party's Tuesday night at 9:00 at the Mean Fiddler. So if you guys want to come.
Hey, before we drop from Hurt No More, Nolan, give some background on the Hurt No More.
Yeah, so Dave Hurt is the Hurt. Jeff Moran is the More, and I'm the No. It used to be called Hurt Me More, and then when I joined in 2009, they changed it to Hurt No More. Yeah, because if you work in the mortgage industry,
it's appropriate in 2009.
Pretty good moniker, right?
Yeah, no,
especially given where cost to originate and affordability have been the last couple of years. So,
dude, that's fantastic. I did not know that history, and I think the first Hurt would have been Hurt No More party that I went to. I think it was probably in 2000, maybe 12 or 13, and it was in Park City. And that was it's epic because of its informal nature around it. And to your point is that it's more closed, not closed door ish, but kind of it was just a way where people can really network without, by lowering some of the, the barriers between competitors and vendors and just have a good time at fun locations. Let me ask you a question about Vantage, right? So what's so interesting to me about the whole Vantage Score, the theory behind it last few years, it makes perfect sense, right? You sort of open up the credit box, right? Where the traditional sort of credit on how you delineate like a credit-worthy borrower from non-credit-worthy borrowers had become sort of narrow, and costs aside, it was just so narrow that it felt exclusionary, right? And of course, in the last several years, when we always have this conversation when market's flat. We had this, in 2010, 11, 12. We had this in, certainly 13. We had this in 18 when sort of origination volume sort of went flat. And then, of course, 2022, 2023, when origination volume sort of really radically dipped. All of a sudden, when we can't really focus as an industry on which every lender wants to do, on clean borrowers, the conversation around or perfect A-paper borrowers, the conversation always swings around how do we open up the credit box, right? But it strikes me that the way Vantage is being implemented is instead of like looking at it to where those people who are being left behind in credit eligibility and mortgage qualification, it seems like lenders or those who are embracing Vantage are now saying, well, on consumers that are 720 and above, we can just do a Vantage, and whereas anything below that, we need to have a more safe and secure environment, which is we're going to resort back to, sort of the traditional models. And it seemed like that's completely, like the hourglass is flipped, where really the whole point of Vantage was to kind of help, underserved, underrepresented credit, all this sort of, those boxes to become more credit eligible. But it almost seems like the hourglass is flipping and saying we're going to use Vantage Score for those that are super, that we want to sort of streamline because they're going to perform. Is that my lack of understanding, or am I actually looking at that trajectory, kind of an interesting evolution of how we're sort of dipping our toe in the water?
Look, I think a lot of this comes down to data, right? It comes down to the methodology of which that data is synthesized and what comes out the other end. You have the three bureaus, right? Equifax, Experian, TransUnion. Each one of those bureaus is going to have a little bit of different data sources, right? You don't have one of those bureaus that is the panacea that has every single piece of data. I mean, it doesn't exist. That's an untenable ask, right? First of all. Second, I think credit is only a portion of what really happens when you're thinking about putting a borrower through to qualify for that principal, interest, taxes, and insurance payment, right? And you can only trade on the data So that's kind of why you have the three bureaus right now. The costs have gotten pretty crazy, and some of this with Vantage or some of this with FICO, the scores are going to be different depending on if you're in the tail or if you're in the super high realm. There's going to be a distribution here statistically. So I think it's hard to really understand that. I do applaud what the bureaus and what the industry has done to get that price down to $1 for Vantage. I think that's helpful, but you still need the trade line data. The dollar gets you the score for Vantage, but you still need trade line data. And you also need a little bit further, I think a little more dialogue and a little more clarification on kind of how Fannie, Freddie, Ginnie, the industry want all this to come together. It's still a little bit TBD, I think.
So the trade line data is almost, I think it's more important than the actual score itself, right? So it almost seems like the score itself is irrelevant. It almost seems like it's not quite.
DTI is a huge component, right? We look at FICO score, but debt to income, I think is a huge component. I think cash reserves are a huge component of all of this. I think I'd be careful to look at just one thing, right? I think you want to be, again, global, holistic, and well thought out when you make any credit decision.
Yeah.
And if you look at Fannie and Freddie, Fannie and Freddie have their own algorithm. They don't really even use the score. They're using DTI, they're using LTV, they're using cash reserve, they're using a host of compensating factors in their model. And I think a lot of other people do as well.
Go
ahead, Bob.
I would tell you, in my opinion, from not being a lender, but from the outside, that anymore, aren't we just using the credit score for the LLPAs and figuring out where you are pricing wise?
Yeah, that's the way it works today, right? That credit score has an LLPA effect, sometimes positive, sometimes negative, depending on where it is. But also, I think if you look at something like Fannie Freddie versus Ginnie Mae, those LLPAs are different, right?
Yeah.
And FHA is willing to take that credit risk down into the 500s for the right borrower, right, and the right LTV and the right circumstances. So there is an ability for people to get a loan if they want it, kind of regardless of where that FICO score is or where that Vantage score is.
Yeah. You know what's interesting about that? There's all this the questions around, is a Vantage score on par, or does it perform differently than a FICO score, right? And the reality, because they're worried about gamification, you're gonna choose one over the other just to get kind of fit a consumer within a box. And I'm like, we gamify it now. We're constantly twisting and turning, trying to determine the best sources of income, the best scenario, what to include, what not to include, what fits the guidelines. We sort of gamify it now, and I don't necessarily think that's a bad thing. I think, you're always just looking at deliverability, sellability, and performance, sort of period. That's, as a retail originator, that's pretty much, that dominates every conversation on every file, right? And so I think this whole gamification question seems so like such a red herring. It's such a, in my view, it seems like a stupid conversation or a stupid comment because I feel like it's just another word being labeled around what we do all the time anyways to try to determine the best way to demonstrate the borrower's ability to repay, like in concrete terms. Would you say, do you think that's a red herring, or do you think that I'm off in that, or do you think there's a real risk in the gamification of, saying like, well, it didn't work here, but it works over here?
Yeah, I think both. I think it depends on what data is available. I think often what happens is you have something that occurs and there's judgment that's immediately passed on that, right? And that judgment often fails to consider all the alternative hypotheses or alternative ways and means that something could transpire, right? So I think it's careful not to rush to judgment, but I think it depends on the data, right? If you look at something, just for an example, something like a buy now, pay later loan, there's a decent chance that's probably not going to be on the credit report. Now, depending on the bureau, some bureaus have a little bit more of that data than other bureaus, right? So, if you're missing something, does that help the score? Does that hurt the score? It could go either way.
Yeah, you're talking about Klarna and these types of like buy now, pay later, or pay in installments, kind of platforms. That is interesting, right? Because debt is debt, right? And anything that sort of takes away or jeopardizes.
And I think that, like to Bob's point, that LLPA, depending on where that LLPA is, that could be, an eighth of a point. It could be 25, 50, 75 basis points, depending on that FICO hit and where that shakes out and where the data is, right? So I think it's important to really be very thoughtful and understand exactly what you have versus just rushing to judgment.
Do you think it's somewhat of a money grab in the sense of, and a money grab might be a bit of a critical and biased way of saying it, obviously. But it strikes me that until the data is there, I think we all intuitively know these are going to be fine. These loans are going to be fine. They're going to perform because we're looking at all kinds of other, ancillary factors, lender by lender by lender, because it's not uniform. Regardless of what the overlays are or the LLPAs are by the GSEs, the lender has to determine what they're comfortable with, and a lender is going to have their own LLPAs on top of it, So I feel like regardless, these assets are going to perform, right? And I feel like, like downstream investors are kind of knowing that, but they still are leveraging this window of opportunity to say, well, we don't know, therefore we need to tack on an extra 15 or 18 basis points or something to that effect. It seems to me that there's a bit of and I call it a money grab, but I don't know what the MBS term is for money grab. But I mean, am I being too critical? Am I under devaluing the downstream, concern or being overly skeptical of it?
Well, I think you're going to say something. I'm happy to chime in now.
I just said I think it's as much uncertainty and not having the statistical data and be able to pull from it. And I do want to make a point about Nolan's continued use of the word data. On just having several conversations with him at Texas MBA. You'd think he's talking about data, all the past data, all the things historically that have happened in statistical numbers. But he shared a couple times that he looks for some, intrinsic information too. And then he has regular interaction with his call center team just to find out what they're hearing and trying to hear, what are the trends going on today and not just relying on, what's past. And I thought that was very insightful and very just show the leadership and understanding of what he has, understanding of the market and what he wants to, have available to him when he's making these decisions and trying to decide direction.
Yeah, I think that's an important part of it. I think, look, the first thing, anytime you run a business and you have a lot of employees that report up with you, through you, around you, you just care about people. Like that's what good leadership is, right? You care about people and you want to get it right. And I think in order to do that, the best leadership advice I've got is kind of the same thing you learn in kindergarten: slow down. You're going too fast, right? So sometimes you want to go fast, but if you slow down now, you can probably go faster later. You really want to think through what you have and why it matters. Yeah, that's like a big leadership tenet that I came across. And at the other part of this is if you look at Fannie and Freddie, whose delinquency is what, 0.5%, maybe less than that, depending on what you look at, or you look at something like Ginnie Mae, where that delinquency is close to 9%, right? Those are two very different delinquency profiles, and they're also two very different kinds of loans. And there's a lot there, right?
Well, in two different types of mission, their missions and their purposes behind which are vastly different. But I think 1.5% is too low. I feel like Fannie and Freddie they're doing fine financially, right? So I feel like they're not taking enough risk or not allowing, or maybe not enforcing. I almost think lenders should be penalized almost for adding too many overlays in their GSE audits or in their applications for Fannie and Freddie, because these are kind of public trust entities. Like our objective is home ownership. It's not we can have no risk on loans and limit the credit box to a degree where delinquency is zero, but does that serve the public good of home ownership? So I feel like 1.5% is annoying, because I'm like, well, that's great. You got an all-star, you have an all-star portfolio. That tells me you're not taking enough risk for the consumer, of which who pays for you, who supports you, through tax dollars in the relationship, the semi sort of public relationship.
Is that a risk thing or a pricing thing? If Ginnie price is lower, and that lower price and that lower payment is better for the borrower, right? Sometimes it's not a risk thing, it's a pricing thing.
Yeah.
Maybe you price for risk, maybe. Or maybe some people are more comfortable with it. Like at Carrington, like we're a little more comfortable with risk because we service the loans and we're very confident in our ability to service loans, right? That's what we do probably better than anyone in this industry. So we're willing to take on some of that risk. And number two, like we just have a big passion for serving the underserved.
Yeah.
Right? Something we've always done at Carrington. And there's other shops out there who have,
as we all should. I mean, to me, if you want to start a mortgage company, that's great. But to me, you cross that line, or a lender crosses that line when they aim to get their GSE approval. Then to me, you go from what you want to do as a lender to what is in the public, in balance with what is in the public good, right? And obviously people in homes, investing in their local communities and local public schools and so on is vital to that public good. And home ownership is clear in that, One last question. I'll wrap it up to Bob for final comments. Go ahead, Bob.
I was just going to say, I know we've only got Nolan for a couple more minutes because he's got a hard stop, but I do want to ask, and I like to hear from every CMB. Tell us real quick about, your CMB journey, and then what's been the most rewarding part since you've earned your CMB.
It's the people. Like the number one thing I love in life is people. Like everything that I have, being kind of this small town kid from Reno, Nevada, who made it out. I am so grateful in my life for the people I've worked with alongside, like Wes Isley's been a huge mentor to me. Andrew Taffet, our CEO, just probably one of the best leaders I've ever worked with, alongside probably the smartest human being I've ever met, ever. But I think it's the people, Bob. Like, the CMB journey, having been through, MBA and PhD programs and the whole thing, education-wise, it's some of the best mortgage education I've ever gotten, ever. Mm-hmm. I think the networking has been incredible. The intellectual pursuit and conversations like these, have just been awesome. And that's probably what I'm most grateful for. You're in this special club that no matter what happens, you can probably reach out to a CMB. He or she is going to take your call. They're going to give you, pretty good market color insight. Sometimes it might not be what you want to hear, but it's true and you need to hear it. And they're going to have an opinion and a thought. And I just love that. I think it's just one of the coolest things I've done in my career.
Well, was there any section of the CMB exam that you failed? Any of the 5 sections?
I nailed it. I did well. I'm a nerdy guy. I care. I study hard. I passed it the first time and I never did the School of Mortgage Banking.
Oh, good for you. Yeah.
I didn't do any of them. I just went like cold, but literally my study guide's 270 pages. No joke.
Yeah, no,
wow.
I failed 2 of the sections, but I have a 270, kind of a 200 plus page guide as well. And I was able to knock it out on the second try. I was able to knock out the 2 sections I failed, but I didn't take the School of Mortgage Banking.
And I failed 1.
So I got my 9:30 waiting for me.
Yes.
But it's been awesome to hang out with you guys. Thank you so much for the time. You guys are incredible humans, and I appreciate the friendship and everything you guys do.
We appreciate your leadership, man. Thank you so much,
Nolan.
for sure.
Right. Bye, guys.
Hey, Bob, you still have a couple minutes?
I get a couple.
Yeah. No, what a great academic and a good scholar, in the business. I love it. We mind share a lot, Nolan and I, on our doctoral sort of process in evolution in the business and how we apply those sort of graduate school sort of data-driven skills to this industry.
Right.
I wanted to ask him one of the questions.
His market.
What's that?
I was just going to say his market insights, his intelligence, the way he looks at things is obviously a very different perspective than what I have. And just being able to be friends with Nolan, which is 100% because of the CMB Society, meeting him through CMB events, and then just connecting with him and hanging out with him at times, and being able to talk to him and call him. And there's times when I've just had unique challenges with something, and I just said, hey, help me understand this a little bit better because I'm seeing it this way. And he's just like, hold on, just take a step back, look at it this way. Here's 1, 2, 3. And it just aligns so differently. So he's definitely a great resource to this industry, to MBA, to Texas MBA. And certainly we know he's doing a great job at Carrington.
Yeah, no, it's, one question I wanted to ask him was this whole, obviously, we all support Bob. We all support the MBA. MBA is not perfect, but the reality is how you get, and the process isn't perfect. There's nothing perfect about anything legislative,
right?
Anything that's an intersection between the public and private part, and I consider housing a public and private partnership, right? You're never going to get perfect outcomes. There's always going to be constituents that are unhappy and everything else. But I think our responsibility, and you embody this way more than I do, but you and Nolan, and I'm trying to be much more involved in the MBA. Both in, I think there's a way of being critical of the MBA in a constructive way, by just being involved and providing good feedback to try to steer the ship. And I think there's too many people who sit on the sidelines, because I think those people just aren't leaders. I don't think that they're people that they love throwing rocks. It's easy to criticize a game when you're not playing because you're on the sidelines. It's another
100%.
thing to have the real courage to be like, I'm going to get on the field. I might drop the ball. I might have some issues, but I'm going to get on the field and I'm going to try to, win. I'm going to try to steer the outcome of the game.
I 100% agree with you, Rick. I know MBA is not perfect. None of us are. It is impossible to be in a political environment, in a geopolitical world that we are today, market-driven factors across the board, and just all the changing dynamics of technology, personnel, remote work. It is hard to think anybody could be more successful. And it is, you don't turn an aircraft carrier on a dime. You can't turn our industry. You can't do it. But under Bob's leadership, under Dave Stevens' leadership was sent before that, MBA has risen as the adult in the room. I'm a member of NAM. I love NAM. NAM's very impactful as well. The fact that they work together on many issues is a great thing. But for those that sit on the sideline, don't want to get their uniform dirty, that was Jack Connick, my predecessor and my mentor. He was my predecessor at WBK, and my mentor in this role as being a non-attorney working for law firms. We'd worked together at National City Mortgage for a bit. That was one of his lines. You got to get off the sidelines. You got to get into the game. Not everybody makes the best play on the best opportunity of every play that comes along, but we have to work together. We need to get on the same page and understanding where things are from different points of view, from brokers, from bankers, from realtors, all of us in real estate housing. That's what MBA does. And then when you try to take that and move it forward between a Democratic or Republican base, or groups that want to work on it, or those that are just actually concerned about housing and understand, let's skip the political part of it and let's go to the family and try to make this work. You're right. You can't just throw stones. You got to be active by your voice, your effort, and many times your PAC dollars as well. Yeah.
No, what do you think of the one question I wanted to ask Nolan was is like Bob's comments, obviously on the the tri-merge requirement.
Basil, what
right?
he just was. Oh, trimers. Okay.
Yeah. Bob calls it like an anachronism, kind of a license for price gouging, that kind of thing. And I totally agree with him. But the question, but is that dead? Like, what's the path forward on that? Because I'm with the NBA on this. I think it should be there should be like a selection of one score. The lender should basically choose that. And then the lender sort of incurs that risk, right, associated with their choice around what score that they want to embrace. But what's the path? Because ultimately there's a supply chain, there's a risk chain, right, that has to sort of endorse that strategy. Has the NBA largely just pulled back from that? Because I haven't heard many comments on it. Or
well, I think it's bad. It's balanced a little bit because of the directions that HUD and Bill Polk, and FHFA have gone recently about what they believe is the best path forward for this. So maybe what we can do is try to get one of our CMBs that's engaged in the credit industry on a future one of these. And I have a couple of thoughts in mind, and I am going to have to run in a couple minutes myself. But I would tell you
that's a great idea.
Yeah.
We got to get Bob on the show.
At some point we will, I'm sure.
I mean, maybe
we just hijack him at secondary and tell him he's on and just automatically start it up.
That's right. There's no greater platform than the Mortgage Podcast by Bob Niemi and Roque.
Or catch him at the holiday party after the Metropolitan Washington MBA event. That's when he's most colorful.
Are you the chairman's event in Maine? Do you attend that?
I am not. I have not.
Yeah, I'm considering that, but well, good. Well, I think this is a wrap for the Mortgage Podcast. I think this is going to be a good episode, and I think there's going to be a good clip there that about Nolan's experience at the CMB. So I'm looking forward to dicing that up and continuing the journey here. Sorry that we had some complications during the regulatory conference and doing the April show, but I'm glad we're back on track.
Yeah, it's difficult with our schedules to try and align everything perfectly every month after month after month. So, but anyway, always good to see you, Rick. Love the conversation. Nolan's a great guy. If you don't know him and you have any reach out to him. I know he's on LinkedIn. He'll probably connect with you and talk.
Yeah. Well, that's a wrap. We'll talk to you soon, man. Thank you so much. And this is another episode, May 4th, of the Mortgage Podcast.